8.2 Income Tax. This section, we are going to determine gross income, adjustable gross income, and taxable income. Also calculate the federal income tax. Determining taxable incomes. For the income tax, it is a percentage of your income collected by the government to fund its services and programs. The federal income taxes are a percentage of your taxable income, which is based on your earning in the calendar year from January to December. When the year is over, you have until April 15 to file your tax return. Calculator federal income tax. There are 3 steps. The first step is to compute adjusted gross income. We're going to subtract the gross income by the adjustments. The gross incomes are all incomes for the year, including wages, tips, earnings from investments, and unemployment compensation. For the adjustment, it includes payments to tax deferred savings plans. Step 2, compute taxable income. Using the adjusted gross income from step 1 and subtracted by the sum of exemptions and deductions. The exemptions based on the year 2012, it is a fixed amount for yourself or the quantity or the amount of 3,800 and also the same amount for each dependent. For the deduction, there are 2 types. The first one is the standard deduction. The second one is called itemized deduction. Whatever that is greater, we're gonna choose that one. Those includes the interest on home mortgages, standard income taxes, properties taxes, charitable contributions, and medical expenses exceeding 7.5% of adjusted gross income, which is all of them the itemized deduction. And the last step, income tax, is calculated by subtracting the tax computation by the tax credit. The tax computation, we use the taxable income and tax rate for your filing status, like single, married, etc., to determine this amount. Or we look at the table to see which one that you're gonna use to compute. And also for the tax credit, the lawmakers have enacted numerous tax credits to help defray college costs. And this is a table that we're gonna use based on your status. Either you are single, you are married, filing separately, you are married, filing jointly, or you head of household. For the single, you could be unmarried, divorced, or legally separated. Married, filing separately, so married and each partner file separate tax return and so forth. That's the explanation. And there are steps like for the first quantity, for the single column, the income up to 8,700 paid 10%. And then after that, up until 35,350, you paid 15% for that amount and so forth. Examples. The first one, calculate the income tax owed by a single woman with no independent whose gross income adjustments, deductions, and credits are given. Use the marginal tax rates from the table. From the information we have, this woman is single with no independence. The gross income is 62,000. Adjustment 4,000, tax credit 500. Deductions, these are itemized deduction. The mortgage interest is 7,500. Property taxes 2,200. Charitable contribution 2,400. The medical expenses not cover the insurance. So for this part, we have to check whether it is exceeding 7.5% of adjusted gross income or not. So we're going to put the note here. We'll come back to see after we already went through the steps of calculating the adjusted gross income or the step one. So let's work on this problem. Step one, we work on finding the adjusted gross income. So number one, which from the gross income provided by the problem. I'm going to put a note here. So this is 62000 subtracted by the adjustment. The adjustment is given to be 4,000. And the value for the adjusted gross income is 58,000. Step one done. Step number two, we're going to compute taxable income. For the taxable income, we need exemptions and deductions. And the adjusted gross income from step one, which is 58,000. So let's make a list. What is the exemption for this case? Since this is a single woman with no independent, we're going to use the first column, and the exemptions per person is 3,800. Exemption is 3,800. Set it aside. And then the next part, we're going to look at the deduction. For the standard deduction, for this column is 5,950. Compare with the itemized deduction, which is the sum of the market interest, which is 7,500 plus the property taxes or 2,200, sorry, and plus the charitable contribution 2,400. And the last number, which is the medical expenses, we call these medical expenses, it has to be not greater than 7.5% of adjusted gross income. So we have to compare with 7.5% of the adjusted gross income. To put on the notes here on the side. So 7.5% of adjusted gross income, which is 0.075 multiplied by 58,000, and the number come up to be 4,350. So we're going to compare this number, the 1,500 and 4,350. So since 1,500 is not greater than 7.5% of adjusted gross income. So then we don't include it. So this number is less than 4350. So then not included. So we do not add the 1500 to this group. So put here, so no medical expense. For the itemized value of these three numbers, it comes up to be 12,100. Next, we're going to compare which one is greater. Between the standard and itemized deduction is very obvious. The itemized deduction is greater. So we're going to take 12,100 as part of the calculation. Therefore, for the step 2, we calculate taxable income, which is from the adjusted gross income. Subtracted by the exemption plus deduction. The adjusted gross income from step 1 is 58,000 subtracted by the exemption, which is 3,800, plus the deduction. We use the itemized deduction because it's greater number than 5950 or greater than the standard deduction. So we're gonna add 12100 to 3,800, and therefore we have the taxable income as the value for the 2,100. Next, we're gonna compute the income tax. So let's add another slide to give more room. And then use the table that we're gonna need for the last part of the calculation here. Okay. Based on what we have from step 2. From step 2, we have the taxable income as the value 42100. And then for number 3, when we compute the income tax, so we're gonna do the tax computation first and subtract it by the tax credit. Recall the tax credit is 500, and for the step 3, we're gonna subtract the tax computation by the tax credit to be income tax. I'm gonna put it here. So income tax is from the tax calculation minus the tax credits. So note that the tax credit is 500 and the tax calculation is from the table. From the table, since the taxable income is 42,100, the column that we use is the single column. The number that we have, 42,100, drops between 35,351 and 85,000. So we're gonna use these 3 rows to calculate the tax computation. So let's make a tier. For 10%, it will be for up to 8,700. And then the next tier gonna be 15% between 35,350 and 8,700. That comes up to be the value 26650. And then the last tier, which is 25%, gonna be the value, which is our taxable income of 42,100 minus 35,350, or the number that we get is 6750. You can verify it by adding these three numbers. You should get back to the value of 42,100. All right, so how do we work on this one? I'm gonna write in different colors here for the tax calculation. We use the basic formula as A equals P times B to find the value as a percent of the quantity. For the tax calculation, the first tier is 10% of 8,700. 10% added by 15% of 21,650, and then plus 25% of 6,750. That means we're going to calculate by computing 0.10 and 8,700 plus 0.15 multiplied by 21650 plus 0.25 multiplied by 6750. And we're going to get the number out as 6555 for the tax calculation. And then we can complete the problem by calculating the income tax as a tax calculation. This formula, oops, sorry, wrong marker. Will be from tax calculation minus the tax credit. The tax calculation is 6555 and then minus the tax credit, which is 500, and it comes out to be $6,055 for this person.